All right, Ron, what is this? What isn't it? And what should investors do?
It's a bear market. Let's just put that one to rest right away. It's the result of the Federal Reserve raising interest rates. It's the result of the pandemic, the war in Ukraine, all the types of things we've been talking about, Kelly, since January that were possibilities that could occur and cause disturbances in the equity markets. It's not Japan in the 1980s. It's not the 1970s. This is a different beast for which we have no analog. The only thing we know that as long as the Fed's raising interest rates, it's going to be very hard for the stock market to put together a sustained bull market rally.
So that's what this is, which is to say, you know, it's the Fed tightening and draining liquidity out of the system, and here we are. What is it not?
Well, you know, I've heard folks on our air earlier in the week compare this to Japan, which was a structurally very different market and had very different inputs when it had its bubble that lasted through the end of 1989. 1970s, we saw inflation take 10 years to reach 13%. And we've talked about this before, going off the dollar, off the gold standard in 71, the Arab oil embargo, the Iranian hostage crisis, policy mistakes that occurred over a 10-year period. This is just not the same type of issue. To me, again, and we've been talking about this and we've slightly disagreed about this over the course of the last several months, were it not for the pandemic and the war in Ukraine, we wouldn't be having this experience, and the Fed wouldn't be, as some people claim, behind the curve. They're not. And I think any calls for even more draconian action by the Fed would only further exacerbate not just downside in the equity markets, but would likely throw us into recession.
Let me go back to the previous guest's feeling that the description of inflation last year as transitory, as a short-lived phenomenon, will go down in history as one of the worst Fed calls ever. Do you agree with that? I mean, we cannot dispute now that inflation came on quick, I think quicker than the Fed thought, and it came on hot, a lot hotter than it thought, and now it's lasted a lot longer than we thought, and so the Fed is doing what Feds do when they get in this kind of bind and raising interest rates. But the Fed wasn't the only entity flushing money into the system.
No, it's not only that, Tyler, but I mean, you know, it's the revisionist history here, you know, kind of boggles my mind in the sense that we're on the fifth wave of the pandemic in the United States, obviously with a lesser degree of severity than prior pandemic waves, but China's still locked down. The war in Ukraine, while maybe you were able to see it coming, has exacerbated disruptions in the food and energy supply globally. So these are factors that are well beyond the Fed's control. We've talked about this now for many months, that whether the Fed saw the war in Ukraine coming, which it probably didn't, certainly not from a policy perspective, whether it thought China would lock down and go to a zero COVID policy that would completely and further disrupt supply chains, again, probably at the time that we were debating this wasn't really in the cards. So, I mean, I think it's really easy to beat up on the Fed for keeping policy easy for too long. But I think the factors going into this inflation are so much different than in prior periods that the second guessing, the Monday morning quarterbacking, I think is ill-conceived.
So let me jump in here, Ron, because all of that would be well and good if they hadn't expanded their balance sheet by $5 trillion.
Yeah, I mean, look, there's no doubt, Kelly, that they probably didn't need to do some of the things that they did. But remember the panic at the very depths of the pandemic, where the Fed decided not only to use the tools that they used during the great financial crisis, but go well beyond that because credit markets were seizing up. The stock market fell 34% in 21 trading days. We were sheltering in place, working from home, going nowhere. I don't think there was anyone who could accurately have assessed what the potential for economic damage was, both in the short run and in the long run. So now we're unwinding this process. And we still have these other problems extant, which would include the war in Ukraine and the continued lockdown in China. Once those start to ease, if we get a break on inflation, the Fed might be able to dial it back. That would be good for the stock market, of course. We'll see where the economy takes us. Everybody, by the way, with respect to the economy, is looking at today's data, the wrong data to look at.
Shepard Smith here. Thanks for watching CNBC on YouTube.